Aloha, everybody. We will get started in just a few minutes. Aloha, everyone, and thank you for joining our Hawaii Economic Association webinar this afternoon. My name is Leslie Harvey, Board President of the Hawaii Economic Association and Guild Consulting Partner. Today, we are pleased to present 3 panelists on banking in Hawaii. As you all are likely very well aware, the collapse of Silicon Valley Bank in March spurred a banking crisis that sunk 2 other mid-sized lenders, Signature Bank and First Republic. This event today has been in the works since then, and we're so pleased that it's come together with a focus on banking here locally. And speaking of local banking, a special thanks to our event sponsor, American Savings Bank. Your generosity is greatly appreciated, and we thank you very much for supporting HEA's mission in promoting public awareness and understanding of economics. If your organization is interested in sponsoring and or collaborating on a future event, please email us, get in contact at info@hawaiieeconomicassociation.com. I am going to get us started today, and then I'll turn it over to our very own board director and moderator, Laren Tamaye. And a heads up, we are recording today's webinar. HEA members are invited to participate in our Q&A by using the Q&A function at the bottom of the screen. This is strictly a member benefit, and if it's something that you're interested in, HEA membership is only $40 for the year. Event resources, including slides and the event recording, will be provided after this event. At the end of today's webinar, please take a moment and let us know how we did via the feedback form. We'll share that link with you at the end, and attendees will also receive that link by email. Should you have any technical issues, during this webinar, please send a direct message to myself and let us know what's happening, and we'll try to get that sorted. And with that, I would like to briefly introduce our moderator today before turning it over. Laren Tamaye is an experienced financial professional with strong background in credit risk, management, and analytics. He's held several positions at Hawaii banks and credit unions, including commercial underwriting, risk analytics, and financial analysis. He is also proud to serve as the board director for the Hawaii Economic Association. Laren, I'll turn it over to you.
Thank you very much, Leslie, and thank you everybody for joining us today when what I hope is a very entertaining and educational panel. I'm going to do some very brief introductions. I encourage you to read everybody's bios, but there's kind of a lot of material that we're hoping to cover today. So I'd like to just get into it. And honestly, I'm just excited to do it. So joining us is Phil Bacchus, who's currently the SVP and Treasurer at American Savings Bank, but he comes to us with over 20 years of experience in banking at small, medium, and large institutions, both here and on the mainland. We also have Isaac Okika, who is the SVP and Treasurer at First Hawaiian Bank. He also comes to us with over 10 years of experience at small, medium, and large institutions, both here and on the mainland. And I want to say congratulations. I saw in PBN's email this morning, he's one of the 2023 40 under 40 members. Congratulations. And we have Rosetta Narvaez, who also serves on the HEA board. She is a banking consultant, but was most recently head of market and model risk at Bank of Hawaii. She comes to us with over 20 years of experience at small and medium and large institutions, both here and on the mainland. So we have over half a century about of banking experience to share with you today. I'm going to set the stage a little bit with some banking basics, and we'll use that to jump into our discussion with the panel. And at the end, we'll take some questions from the audience. So I will start. Rosetta was kind enough to put together some slides that illustrate how a bank works. And like I said, just kind of set the stage locally, because banking is an industry that just a lot of people use, but never really take the time to get into. So locally, interesting to know, we have about $73 billion in deposits in the state and about $84 billion in assets. So this is as of the first quarter of this year. And something that's always interesting to point out to people is in both deposits and assets, you'll notice that First Hawaiian Bank and Bank of Hawaii really have the bulk of that. And following below that is American Savings Bank and CPB. You have smaller institutions that follow, and then credit unions hold nearly about a fifth of deposits and assets in the state. A lot of people just don't know about how the different institutions compare to each other, at least on a basic level. And so how do banks make money? How do they work? It really starts with trust, because depositors, you and me, and small businesses and big businesses, we trust an institution and to hold our money. And we put our funds into checking accounts or savings accounts, whatever it may be. The bank will take those funds and make mortgage loans, auto loans, personal loans that we use or small businesses will use. And we will pay the bank interest for those loans. So a bank generates interest income on the loans that it makes. The funds that it uses, though, they have to pay for that. We know that because we get interest from banks on our savings accounts and CDs. So that represents an interest expense for the bank. So between the top line interest income that the bank receives and the interest expense that a bank pays, you have your net interest income. Related to this is the concept of your net interest margin. And that's just when you compare the interest rate on the income received versus the interest rate on the income expense or on the interest expense. So those funds are used to pay for the rest of the bank's operations, salaries, IT, rent, marketing, pretty standard expenses. And what's left over, the bank can use to invest in securities or bonds or capital improvements, kind of like a standard business that you might be aware of. So taking this, we want to explore more current events, like Leslie said. So I'll ask Phil and Isaac first. How would you guys describe the failures of Silicon Valley, Signature, First Republic, basically what's been happening in the industry? How would you guys describe it, and compare and contrast for everybody, the local institutions?
Great. I'll take that one to start, and then we could obviously feel free to jump in if I missed anything. But before I talk about Silicon Valley specifically, I would like to just rewind the clock back to the pandemic, right? And really that's the start of what changed. There was a lot of changes in the banking industry at that time. So if you think back what happened, we had a global pandemic where, there was a lot of uncertainty in the economy. Everyone had to go in their houses and shelter in place. And with that, the global economy actually shut down, right? So in response to that, the Federal Reserve lowered interest rates all the way to zero, and they started putting a ton of quantitative easing in place in addition to lowering the Fed funds rate. So what quantitative easing did, along with a ton of government stimulus, that really resulted in a huge uptick in essentially deposits, right? So what you see on the screen here is actually the Federal Reserve balance sheet, and this is an indicator of the amount of liquidity that was injected into the market at the onset of the pandemic. You could see that steep line up there, right, in 2020 when the pandemic hit. And you could see it continually goes up before starting to trail off in 2020, in 2022, which I'll talk a little bit about there. But basically, this stimulus money essentially ended up on the balance sheets of banks across the country. And then at that point, banks needed to make a decision on how am I going to go and invest this money? I could either keep that in a bank, just keep it in cash and earn 0% interest, pretty much nothing, or I could go and invest that money. There's not a lot of lending activity that was happening at that time, so that money essentially got deployed in the form of government-backed security investments across the entire banking industry, and that was very typical of what you saw during the pandemic. Okay, so you essentially have a ton of deposits, a lot of excess liquidity that came in, but then if you forward the clock to 2022, now you're at a place where you're essentially have a lot of inflation, right, due to all of that money. And that inflation and the opening of the economy, really, the Fed had to change course. And they saw that, inflation was really getting up to, 4-decade highs. And ultimately, they had to respond in kind with, again, using the Fed funds rate. So Fed funds rate essentially went up 500 basis points in a little over a year. And at that higher rate, essentially, you started to see the deposits start to leave the banking environment, right? So if you flip to the next slide, you could see the M2 money stock measure, which is really essentially an indicator of all of the dollars that are in bank balance sheets. And you could see that started to go down. And it's in fact going down at essentially unprecedented levels. Why did that go down? With higher interest rates, you essentially start with your commercial deposit customers, right? They're now saying, wow, I could actually earn money on my excess cash. I'm going to go ahead and remove it from my banking account and invest that either in bonds or invest it in the equity markets, or actually deploy that in my business as the economy opened back up. With higher cost of funds, with higher interest rates, business also had to tap in to that cash. Rather than borrowing money, I'm going to tap into my own cash. So you saw that money start to drain for those reasons. And then on the consumer side, essentially with higher inflation, people have to spend more money to live. So you could see that the stimulus checks that, essentially sat in bank accounts, customers started using that. So that globally happened across the entire banking industry. Now let's talk a little bit about Silicon Valley specifically. Silicon Valley actually grew at a much higher rate than most banks. So just to put it in context, the local banks grew here in Hawaii by 20 to 30%, whereas Silicon Valley essentially almost tripled in size, right? They grew from a little over 70 billion at the onset of the pandemic to $200 billion back at the end of 2022. So that's a massive increase. And not only did they essentially had to go and put that money in investments, their concentration of investments actually were over half of their entire balance sheet, right? So that's the other thing that was an outlier there relative to a lot of other institutions that had growth, but not that growth at that high. So what was the things that caused Silicon's, I would say, issues, right? So the first thing was essentially they were very exposed to one type of customer base, right? They were very much exposed to VC funded startups, right? So essentially almost 80% of their total business was that type of customer. So if you think about what happened to the VCs and startups in a higher interest rate environment, you're talking about cash burn, right? And that cash burn was drawing down pretty quickly, and they had to essentially replace that cash burn with wholesale funding, right? So that's one thing that was very different for them. The second thing is that a lot of they had so many deposits, it was really significantly above the FDIC insurance limit. So the FDIC essentially guarantees deposits up to $250,000 per account, and you're talking about Silicon Valley had 94% of their deposits above the FDIC insurance limit, right? So if you think about that, you had low cost deposits that became high cost with the higher interest rates. You had a loss of those funds that had to be replaced with wholesale funding. And while your investment portfolio that was essentially invested in at zero interest rates are now essentially being valued much lower, right? So as Laren mentioned, banks make money between the difference of what they earn on their investments and what they pay on their deposits. So their deposit costs went up, but their investment didn't go up nearly as much. So that was a margin squeeze. So all of those things essentially impacted Silicon Valley in an outsized way, right? And ultimately that led to uncertainty, right? So, they're trying to raise liquidity, and then, you essentially have, the treasury of Silicon Valley trying to keep up with that deposit outflow. So they're trying to go and raise money. So they went out and said publicly that, hey, we are actually trying to sell some of our bonds and to raise money, right? So they made that announcement, and they were going to look to replace that loss with a new set of equity, but that deal wasn't done yet. So they essentially went public with a balance sheet trade before having the deal complete. And that set off essentially some, it's really spooked the market. So then you had additional customers say, wow, I don't know what's going on with Silicon Valley. They started drawing their money down. And then you had a lot of these VCs posting on Twitter and really driving that I would say the, fear. And essentially that's really what led to the demise of Silicon Valley. They couldn't keep up, right? And that also obviously led to a contagion in the market with First Republic Bank and Signature Bank, okay? And they had very similar size. They had high customer concentrations and also high levels of uninsured deposits. So what's different with local banks? So if you think about the market share slide that was shared by Laren, if you add up all of the deposits and loans in Hawaii, that doesn't even add up to Signature Bank, right? Which was the smallest failure at 100 billion, right? So you could think about that. It's a much larger institutions that failed versus all of the banks locally, which are smaller there, and they don't have nowhere nearly the customer concentration as Silicon Valley. We in Hawaii, we're more like community banks, right? So we essentially have a very diversified customer base in different industries, different sizes. So that's really a good thing for lower deposit concentration, a lower amount of uninsured deposits, and also lower average balances. So that's a good thing to have on your funding base, a lot more diversity there. Also, those deposits were much more stable in Hawaii than on the mainland, right? If you think about the banks here, we're all banking customers that have been around with us for decades, right? So that's a really good thing to have in Hawaii. And then I would couple that with our relatively conservative credit standards here in Hawaii. I think those are all things that differentiate the local banking environment versus what happened at Silicon Valley. I don't know if Isaac, you had any other comments on the local market or Silicon there.
Yeah, that was a great explanation, Phil. Not much else to share. I think that was pretty comprehensive. I think, one thing I'll share from the internal perspective of a bank is, a lot of folks kind of wonder, why did they not see this coming? And that's a pretty interesting question. The big functions that we in the treasury groups, Phil and I share this responsibility is we model and we estimate what could happen. For Silicon Valley Bank, First Republic, they're, like Phil said, they're very fast growing large banks with a concentrated business model. And if you look back to the past 15 years, interest rates have been near zero. So when you think about what your customer behavior is like in that environment, you don't have a lot of observations. So when they were going out, measuring the scenarios, stress testing their balance sheets, they were making some pretty big guesses on how their customers might behave. And in a way, a lot of those guesses or estimates, did not, come true. Some of the customers may have been more sensitive, whether it's to rates or the risk aspect. And so a lot of their models didn't quite play out the way they thought they would. So from our standpoint, that's a pretty big part of our job, is to really think about, how to make those estimates. It's not a single estimate. There's things that we do around, stress testing, thinking about what could happen or the what ifs. But I think that's also another big driver of this, and a pretty interesting aspect. That function in a bank is called asset liability management. So a lot of you folks may have, heard that topic come up, throughout this, banking crisis. And then, like Phil said, I think the granularity of our customer base, we have retail, we have commercial businesses, wealth businesses. Some of us have even like corporate type of deposits. The diversity of the balance size is pretty granular. And then a lot of one metric that gets a lot of attention these days is, how much uninsured deposits do you have? And for both Silicon Valley Bank and First Republic, that was a pretty large amount. But that's all I wanted to share, and see if any others have any comments.
Well, I would add to that, and this is probably what differentiates the Hawaii market from the national market. And this played out when we had consultants come in and so forth, is the long-term relationships that not only just 10 years or so, they're generational often. That may have changed a little bit given the fact that sort of increasing rates, digitally being promoted online versus what the local banks were offering. But I think that even that really didn't pull very much from a retention perspective. I'm sure that there's that kind of measurement. And then you also talked to the stickiness. So in addition to stickiness, there is a measurement that you and Phil do with your departments, and that is measuring the core versus volatile. So, and that is the measurement of how sensitive or how rapid usually a very large depositor like a commercial or business will leave, and also sometimes personal will leave depending upon the rate sensitivity of the market. So, and the fact that banks tend to be very reluctant to, sorry to say, to increase rate payment. So just wanted to add to that.
Actually, yeah, that kind of flows into this idea, right? I've heard Chris Willen of IRA Investors and Joseph Wang, of FedGuy.com, they've both talked about this, how before these recent events, it was very common to say, well, high rates are good for banks. That's when the bank is going to make money, when the rates are higher. But can you guys explore this based on what you guys are saying? You agree, like that's not necessarily the case. So can we dig into that a little bit more? How might the idea of high rates being good for banks actually be true or untrue?
Yeah, I'll take that one first and then open it up after. Generally, I think that is true, but there's a lot of nuance. I mean, this cycle is a lot different in the speed of which rates change and the magnitude. But just want to unpack that thought of why normally you'd think that higher rates would help banks. In terms of bank loans or assets, those are priced at market. So, as rates go higher, they get priced up pretty much at the same, levels. The timing of that can differ across banks, but if you think about a mortgage rated, if treasury rates move up, the mortgages are going to almost always be priced higher than treasuries. The flip side is deposits do typically lag. If you think about a checking account, the rate on that, if it's non-interest bearing, doesn't move. So if you have your assets moving, but your checking account yields staying the same, the net interest margin or the difference between the loan yields and deposit yields are going to get better for a bank. So with small moves, you do see that benefit that, banks are able to move up that asset or loan yield up, and then the deposits typically hold. But what ends up happening in a very fast moving rate environment and a larger scale rate environment, there's kind of two things that happen. There's like time, and then there's pressure. And what that time and that pressure does, it changes, customer behaviors. I'll start with the asset side first. If I have a mortgage and interest rates rise, I may be less willing to prepay that mortgage, whether it's to refinance, take cash out, or even like move. I might have second thoughts of, hey, if I move, I got to get another mortgage at 7% instead of 3%. So it makes the asset side a lot stickier, and asset yields tend to move a lot slower because banks get that cash back a lot more slowly. On the flip side, the deposits have almost this opposite effect. If interest rates go from 0% to 1%, maybe that's not enough for me to move my deposit yet or seek a higher yield. But if suddenly you're seeing market rates at 5% and I'm still sitting at a few basis points, a lot of customers may start to think twice and look for either higher rate alternatives. They could be looking at CDs, savings promos, or they could actually just move their money out into some other instrument. We've seen things where customers are talking about Treasury Direct. For commercial customers, there's money market funds. There's a lot of other things you can do with that money, and suddenly that differential becomes big. So rather than customers behaving the same way when rates were low, suddenly their behavior starts to change. And what that does is that starts to magnify the mismatch between your assets and your liabilities in terms of how they move with interest rates. And that could potentially, compress your margin. So what's pretty interesting is if we go back to, the second half of last year, it was a pretty good period for most banks, excluding, a few outliers. Most banks were seeing, margin expansion, mainly because they were experiencing the impacts of higher asset repricing, but the deposit side, didn't quite catch up in terms of borrower behavior. Q1, I think it was amplified by the banking crisis with SVP and others, but customers started to really think more about the deposit side of what's going on, and certainly the concerns around safety also drove that behavior to have customers think more about their deposits. So what we're seeing right now is deposit, whether it's attrition, meaning leaving bank balance sheets, or the rates that banks have to pay, that has a much more amplified effect today, which is the time and pressure component. We're seeing the pressure on the deposit side. So for some institutions, that deposit cost could start to increase faster than your loan yields, which starts to compress margins. I don't think we're at the point where banks are worse off than they were when rates were rock bottom near zero, but the trend is starting to crest where margins are starting to compress, and it's really about the time and the pressure to see how far that will go.
Yeah, I guess a couple of things I'll add to that. As Isaac said, the short answer is typically yes, but this time no, right? So if you think about what's going on in the type of market, it's why are interest rates going up, first of all, right? And how fast are they going up, right? It's the time and pressure. So pressure is pretty much at 40-year highs, meaning that the speed at which rates increased, essentially, it's easier to change the customer dynamic in a much shorter time, right? So that lag effect that Rosetta and Isaac mentioned, that banks thrive on, you have less of that impact in this rate environment because there was a lot of headlines around the country around interest rate increases, like what's the Fed going to do? What's happening with inflation? So not only are your commercial customers getting hit with that, which they would always do, now you're talking about consumers getting hit up with all of those headlines. So they're saying, wow, there's other things I could do with my money, right? So that exacerbates the problem that Isaac just mentioned. The other thing too, it's not only the level of interest rates, but the shape of the yield curve. And why that is very important is because banks typically invest and fund at different points on the yield curve. If you think about bank deposits, they've been going up pretty high, right? You could get a CD rate for over 4%. You have MMA rates at 3.5% to 4.5%. That's really showing you that those deposits are really being priced off of the short end of the curve, which has gone up, as I mentioned, 500 basis points. However, as Isaac mentioned, you're investing in mortgages, commercial real estate loans, right? Those are really being tied to the longer end of the curve. The mortgages are traditionally tied to the 10-year treasury. Commercial real estate loans are 5 or the 10-year treasury. And then you have, C&I lending, which are more floating rate in nature, but typically you have less floating rate than fixed rate, especially here in Hawaii, where real estate is one of the biggest components of wealth and the biggest components of bank assets, that you would see. So if you think about it, if you're borrowing at a rate that's higher than what you can invest in, that equation of NIM is going to automatically get thinner. And that's really the margin pressures and the cresting that Isaac is talking.
When I'm going to ask the question from the consumer's perspective, because the situation that you guys are describing, it's a very tough place. As you're saying, the cost of doing business essentially is just got jacked way up high in a very short amount of time. So for you guys, what are and it's the Economic Association, so I have to tie this in. What are the supply and demand factors that are at play when you're deciding, how much are we gonna pay on our deposit accounts, checking accounts, whatever the case may be? Like, what are the things that you guys are considering when you're making those kind of strategic decisions?
Yeah, I'll start. I think for us, it's really about our, what is our business model and what are we trying to offer for our customers? And especially with deposits, I think there's 3 things that we think about. There's, one, there's safety, there's also service and convenience, and then there's also rate. So different customer segments, we try to figure out what the value proposition is. And then we set the pricing or the services, based on that. For example, like the wealth segment, that's where, the things are going to be more competitive because it's a larger balance, but it's a more dormant balance that's more for investment purposes. If the account is more for operational purposes, then it's less rate driven because we're trying to provide either safety and convenience, whether it's through the branches or different services. If it's for example, commercial customer, there's cash management associated with that. But it's really defining that value proposition. I do think it is interesting because a lot of that gets confused when you just look at comparable products online, because certainly rate takes the headlines, but I think for us that's what we're trying to balance is what is that value proposition between those 3 factors.
Okay, so I'm gonna stick with kind of from the consumer, from the non-banking side, and ask a question about I guess more locally. So can you guys describe to us for in the same way that the cost of business is going up for you guys, we very often hear that doing business in general in Hawaii is very difficult. It's not the friendliest state to small businesses or businesses generally. How are our local banks helping to improve that situation? How are local banks helping to make a more small business friendly environment here in Hawaii?
Okay, I could start with that one. So banks have a really important role to play in the small business community, especially in a place like Hawaii, right? In an island economy where, you do have those borders, but you also have, essentially a more community-based environment where we do have to cultivate our own customer base, right? It's not like, we have an unlimited set of customers to go after. We have to actually be in partnership with them to help develop and build in affluence, build in capabilities over time. So I think of bankers as being a trusted advisor to our business, right? To businesses, right? Understanding, hey, how should your business have access to capital? What are some ways that we could make that happen, either at our bank or either partnering you with maybe a community development financial institution or some other type of mechanism to get access to capital. It's also working with our business partners on financial literacy and financial education. making sure that new businesses have the tools in order to assess their business health, in order to build their business and ultimately achieve growth over time, right? So, we spend, time essentially working with small business incubators and thinking at, looking at new business ideas and help volunteering time and dollars in order to help cultivate that locally, right? So I think those are all good things that banks should be doing, and obviously we have a really big responsibility here to continue to develop that.
Yeah, I'd echo what Phil said. I think, we think of ourselves as, certainly a partner, and part of that is, not just the lending, deposit and products and services that we offer, but it's really being an advocate and being in the community. So, what you'll see is with a lot of the bankers here is that they're inside the community, they're active on boards, they're, actively networking, and that's valuable for small business in the sense that it helps the small businesses make additional connections, whether it's to get help with professional matters, but to also connect with other businesses, and customers. I think the banks are also at a good point to help advocate at not only the private but partially the public level. I think in PPP, with the PPP forgiveness program and the access to that liquidity for small businesses, I think the Hawaii banks did an incredible job. For the amount of the size of that program is several $billion. If you look at the total deposits here, it's not that large so it's a large portion of the balance sheets here that the banks use to help small businesses. So that's another place that we can also help.
Yeah, I think if I remember correctly, I think on a per capita basis, Hawaii was very much an outlier in PPP funds received, and that really owes to the financial institutions here. I did kind of want to jump off of your comments. As you're partnering with local institutions here, local businesses, where are you seeing areas of opportunity in the local economy?
I'll take that. I think the traditional avenues obviously are the tourism sector, defense, and even local government. With the tourism side, I think we're not quite where we want to be yet in terms of arrivals are kind of back to where they were, but the mix in terms of international is still lower than it was in the past. So I think helping to prepare that industry for that gradual return is something that we think about. We also try to help think about the longer term. We want to be a more diversified economy. So, for example, we try to help support innovation, sustainability. For Hawaiian, for example, we participate in providing grants and other things to things like UH's RISE program. But I think it's really trying to help cultivate new areas and new industries in addition to more of our traditional ones is a really big focus for us.
Yeah, that's right. Diversifying the economy, I think that has been a topic of discussion in the state of Hawaii for decades, right? And I think the pandemic has essentially provided another bite at the apple for coming up with new ideas and new ways to innovate, right? So there are a lot of people across the state really focused on this question, right? And I think one of the things that we need to think about as a banking community and also, as larger business communities, how can we bring together people in order to essentially enhance outcomes, right? Rather than having folks kind of work on their own things, let's hooey up and really figure out, what's the best path forward. So yeah, I think that's something we need to really focus on as a banking community. In terms of where do I think there's some growth potential, I do think sustainability is huge, right? So that means a more sustainable agricultural system where we reduce our need for importation of food, right? I think that's one area that we could continue to cultivate and develop. I think another area is in the areas within STEM, right? If you think about software engineering, or maybe it's even in the field of energy, right? Looking at sustainable energy. I think that's another area of growth in Hawaii. So yeah, I think at banks, we need to go and help bring those businesses to fruition and get them into bankable status, right? So that's why, as Isaac mentioned, we have to be in our community as leaders, really providing ideas, thought leadership, working with boards and bringing people together. Our bankers do that all the time. We also participate in the UH Venture competition, right? We have Bank for Hawaii kind of looking at some of the new business ideas that are being developed and really providing grants, time and dollars into that type of work. And also, in terms of financing those next industries, right? Sometimes, there are certain types of investments that banks cannot make because of our regulatory requirements, but can we partner with an institution and have them deploy capital, and then we could be working behind the scenes to help bring those companies up, right? So that's another thing. And then in the field of, let's say, sustainable energy, clean energy loans, I think that's an area of focus for us that we want to make sure that we're building up, so that that's also tying into housing and reducing the cost of owning a home, reducing energy costs too. So things like that, I think banks are doing, but obviously there's a lot of room for growth there over time.
So I want to take that from a little bit of a different angle, because one of the biggest issues that we have in Hawaii is the cost of housing, right? So actually, Rosetta, I wanted to ask you, because we've talked about this before, in the same way that banks can have a positive impact on the small business environment and the economy, how do you think that our local financial institutions can positively impact something like the high cost of housing? Like, is there anything that can be done or should be done?
If you want to bring up that one slide that has the cost of housing and for Hawaii compared to the rest of the country, it's pretty startling. So this that's the blue line is Hawaii, and you're way above sort of everybody, which is probably leading to a lot of the flight to the mainland that we're seeing with our local population, just simply not able to afford a median home that's very close to $1 million by the end of or at least in 2023. So it's pretty startling, and that's Oahu. That's that doesn't even factoring in Kauai, Maui, etc. So one of the ways that banks really are able to help local communities, in addition to what's called the Community Reinvestment Act, that sort of mandates that banks that are in their communities doing a certain amount of small business lending, a small certain amount of mortgages, et cetera, to underserved populations, is the fact that they can tap into ability to sell the mortgages within something called a package. So you sort of conform a number of mortgages to similar attributes, like ranges of FICO scores or values, etc. For Hawaii, those conforming thresholds are very different than the rest of, for example, than Arkansas. Even though it's supposed to be on a national norm, there's allowance for the high cost of housing or values in Hawaii. So what you see is that banks here are able to sell and conform to both Fannie Mae and Freddie Mac. These are two government-sponsored enterprises, GSEs, and tap into that market, that sort of ability to bring more liquid. So mortgages don't necessarily have to be held on the books, but can be, sold and then potentially reserviced back by the bank. So that is one way that banks are actively in the able to provide sort of the liquidity into the state. Other areas are really in helping potential homeowners in workshops and et cetera that are held by the bank in the community and under the sort of CRA program to sort of demystify, if you want to use that word of banking, demystify how you go about qualifying for a mortgage and what that looks like. So that's sort of another mechanism that banks can do. And the other is potentially being able to sell homes that are obtained by the bank at a much lower rate. There's something called multi-house project that banks here buy into and help to finance so that multiple dwellings, for example, are available to the state. So I'll pause here and let the others speak to this. And I just want to remind you, we don't have too much time left on the clock. Sorry to take that.
Yeah, I think a couple of areas that banks could help. Well, another traditional way is through low-income housing tax credits, right? That's the bank making direct equity investments in affordable low-income housing projects, right? So that's something that all of the community banks do here and participate in, and oftentimes we're actually hooing up together in order to make those investments, right? Another thing we do is we partner at ASB, we partner with developers in creating special loan rates for, basically your first-time home buyer or a purchase of a home, a primary residence versus a second home or investment property. So it's really focusing on the people's primary residence, right? One of the things that Rosetta mentioned was the Fannie Mae Freddie Mac framework, but banks actually have the power of their balance sheet to actually put loans on books, right? So there might be loans that might not fit that box for Fannie Mae and Freddie Mac, but still may be a very good loan to make. And that's very true in the state of Hawaii when you have homes that might go into the multi-millions, right? So it may not fit that. So let's use our balance sheets wisely and basically deploy either a wider, I would say, underwriting standard or a rate that's a little bit lower than a mainland saleable rate, right? So and really it's programs, right? Coming up with new products and programs that would help. One of the ones that we're rolling out is we have a first-time home buyer program that takes the Fannie Mae program and extends it up to 140% AMI, and that allows for basically a lower monthly payment, lower percent down. So things like that, I think we got to get creative as banks in order to help people afford not only the entry into the home from a down payment perspective, but also from a monthly cost from a debt financing perspective.
So a lot of that, I mean, a lot of that does sound like it's going to rely on a lot of outreach. It's going to be doing the best that a bank can, using the power that it has with the GSEs, Fannie and Freddie, or like you said, Phil, with your own balance sheet. To me, that it sounds like it's going to require that more digital aspect, which is another topic that does come up, how Hawaii is connected or not connected to each other digitally online. But I keep reading and seeing that, especially with the recent events, the digital adoption of bank customers is a double-edged sword because it gives more opportunities, like being able to reach customers to introduce them to their mortgages, products, and services. But it can also be destabilizing if it makes something like a bank run that much faster and that much more impactful. And again, sorry, Rosetta, and I know we've talked about this before, so I'm going to kind of direct this at you at first. What's your opinion on this? And especially given that you're consulting with different banks, like, is the general view of more digital adoption, is that a good thing for banks, especially local community banks like we have?
Yeah, and I shared one of the slides that I shared. It's top of mind for all banks to be sort of digitally innovative and often partner with fintechs to get at that digital capability. It's the one of the number one requests from customers. So that's absolutely sort of a requirement, top of mind requirement for banks. The I think there was a general feeling that banks could be more profitable if they adopt innovation and digital means of doing business. It's less about becoming more profitable and more about cost efficiencies, as well as being able to deliver to the customer how they can bank, all the different sort of mechanisms by which they can bank. That said, there are, at least from what I've seen from the regional banks here, there are a lot of sort of safeguards that are put into place and may have arisen primarily because of the nature of being an island or regional banks that are out in the islands and just wanting to safeguard from a fraud and anti-money laundering perspective. So a lot of the what I've seen from a P2P perspective or a person-to-person payments like a pop-up or Zelle or Venmo, whatever, is very much capped, for example. So you can't just sort of shift out 10,000 in a Venmo transaction to another bank. There's a sort of a lot of safeguards that are put into place in terms of being able to access funds digitally. So, and that's, I think it is, twofold from the anti-money laundering perspective, the fraud perspective, but what it also does, it puts the brakes on being able to transact large volumes of dollars or deposits very rapidly. Intra-island or within the region, yes, but outside of the island to maybe a web-based bank, maybe not. So I'll pause there and let my colleagues speak. And I think we're running out of time.
Yeah, I'll make a quick comment. I think for us, especially thinking about deposits and the bank runs, it's really made us think about what our value proposition is. And, I think there's customers that are looking for safety and service. There's customers looking for rate. And we try to figure out what we're offering and where do we fit in. And when we look at digital, we think of it more as an enhancement to our overall branch experience. I think it's a channel where maybe a lot more of the lower value activities, so paying bills and transferring money, that's where it can occur. But the branches here in Hawaii do serve as a kind of bedrock for safety and comfort for a lot of folks. So when you have your operational account, I think there's a value proposition for having it here versus, let's say with a direct bank. But if you're just looking to park some money and get the highest rate, then, that's a different story. But with that said, we also try to figure out the product offerings to, get that high rate, even though we have a higher expense base that we need to cover, things like CDs or other things or promos that the banks are doing here, try to find that balance for customers and, really balance all three options that they're looking at in terms of, a safe place to put your money, the services and convenience that you want, whether it's through digital or at the branches or hybrid or a good rate.
Well, yeah, thank you so much. I'm gonna jump into some of the audience questions here because there's been a couple about kind of how high rates impact lending. There's one specifically that I thought was actually a really interesting comment. That in the real estate industry, there are people that feel that actually rates don't have too much of a direct impact on the real estate market here in Hawaii because it's more about the lack of supply. I imagine that this is speaking more to residential supply, at this point, probably industrial as well. If you guys can comment on that, and then kind of related to that, there's a question about how higher rates are impacting lending in general. Are you seeing Are you seeing it harder for commercial loans to get funding from local institutions? I know on that, I'm just going to make a quick comment that the last couple Federal Reserve senior loan officer surveys have shown that credit tightening has been going on, at least at a national level. But I'll turn it to you guys.
I think Hawaii's been pretty unique in the past where, there was a huge abundance of deposits and then a lack of availability of loans. Just based on a market, it's very real estate driven. And not as much like corporate and commercial activity. So the deposit side was very rich, but the loan side was low. However, what we're seeing today is that, during the pandemic, a lot of the banks here did kind of place a lot of those deposits, whether it's in loans and securities. So you've seen like a lot of loan growth in the past year. But this year's what's pretty interesting is that the deposit balances starting to decrease. That's a trend that we haven't seen here in Hawaii. So I think it does change, our ability to make the same loans that we did last year. So this is a recent shift, but you are seeing the Hawaii loan rates gradually catch up to the mainland rates. I think we're still lower, but historically we've lagged for long periods of time. But given the speed and rate of the rate move and what's going on in the economy, our loan rates are pushing up. So I do think that's going to have an effect on the real estate market. I feel it like finding a home or buying a home is pretty tough. So the supply side, is another consideration. But I think we are starting to see those two kind of pressures interact with each other. I'm not sure where it's going to like shake out, but I do think it'll cause a little bit of a slowing in, the real estate industry.
Yeah, I think that comment was more geared towards, what happened during the global financial crisis of 2008, right? And I think, yeah, at the end of the day, being that we are essentially island bound here, we do have that lack of supply. But to Isaac's point, in an environment where you have, you're deposit rich and loan light, you could basically that leads to lower rates on loans and lower yields on deposits, and that trend is definitely changing, right? So as that changes, you're essentially seeing that flow through to loan rates across the country and loan rates across the islands here, right? So honestly, that's what the Fed is designing to. That's what they wanted to see, right? They're trying to tighten financial conditions by raising interest rates. So they're definitely getting that on the mainland, and it's definitely happening here too.
Okay, and then there's a couple of regulatory and CRE questions. I'll ask the CRE question first because that's of interest to me. I'm taking moderator privilege. One of our audience members is observant and does know that local banks have a pretty high concentration in real estate, specifically commercial real estate. Can you guys comment on the risks that you're seeing in those sectors? I know that is coming up more often in terms of credit risk, even though right now more of the focus is on liquidity.
I'll take a quick shot first. In terms of commercial real estate, I do think it's a different market than some of the more headline markets in the mainland US. The building I'm in is actually the last building that was built in downtown, First Hawaiian Center, which was, several decades ago. We are also starting to see the supply of commercial real estate in, like, for example, downtown Honolulu shrink as some of it's converted to, residential. So I think the use and availability of commercial real estate, particularly office, is a lot more well distributed here versus, there's bigger supply and demand mismatches in, California or Washington. So I do think we'll fare, better, just geographically. And then if you look at the underwriting asset quality experience of the local banks, it has been pretty strong. So from a risk standpoint, I do think the Hawaii banks will probably fare better than the mainland US, in addition to just being in a better market.
Okay, and then kind of somewhat, I'm going to change the questions a little bit just based on your comments, because I know, like I was saying, the CRE exposure is becoming a topic in terms of credit risk. I was wondering if you can speak to, we also have a couple of questions about potentially more regulation coming not only to larger banks, but to local community banks as well. So can you comment on how the local institutional strength, capitalization, where do we stand, especially if regulators are going to start asking for more?
Yeah, I think that's definitely something that you will see, right? And after every, I would say, banking crisis that happens, there inevitably will be a review of the regulatory policies that are in force, and ultimately an update to that. So I definitely expect that to come through. The key thing is some of the things that Isaac mentioned at the beginning of this call, which is in your normal course of business, you need to really understand your customer, understand the risks of your balance sheet specifically, and ultimately you don't solve for one outcome. You have to look at multiple potential futures, right? Stress testing is very important, and really looking at what could happen, and also what has happened in other places that maybe had never happened in Hawaii. What if it happens here, right? So you have to be looking at that consistently. And I would say that the institutions that are consistently doing that and demonstrating that they're keeping ahead of that bar, they're going to be in a good spot. And obviously, I think some of the headlines that you hear around uninsured deposits and deposit concentration, I would expect to see regulators, develop more questions around that, as they come and examine the institutions across the country, right? If you think about it, some banks are regulated by the Federal Reserve, FDIC, you have the OCC. So I think they will have to get their heads together to really level up what that regulatory framework needs to look like.
Thanks. Rosetta, actually, I was hoping to direct this question to you at first, and if Phil and Isaac, of course, feel free to jump in as well. But the question is about our local market and the opportunities or risks, depending on how you look at it, for consolidation or for a mainland entrant to come in. We know that those attempts have been tried. I don't know if we've had any really strong mainland success story, but things are very different now, right? So, you have a good view of banks as a whole here. Like, what would you say are the opportunities for either consolidation or for a new entrant?
I mean, I find that question very interesting. I think somebody raised it in the Q&A as well. Because quite honestly, we've got some great deals right now going on. It's fire sales with our local regional banks. Sorry to say, even though it looks like the market's up today, but and so any area where the balance sheets might be weak, banks may want to just make sure they're shored up. Because there's a lot of eyes out there in terms of M&A, and M&A is still very much on top of mind of banks that tend to do acquisitions. That, in fact, that's how Silicon Valley Bank had grown so tremendously. It was just massive amounts of M&A in a very short time. But in the case of Hawaii, there is the factor that we are in a highly regionalized area, and huge amounts of concentration in terms of the industry, both in terms of tourism or visitor industry, military and government. So those are the sort of three big ones here. And so banks would want to be careful about what they are acquiring, because that kind of concentration has led to our certain types of ratings, like rating agencies being careful about how they do how they rate the banks here because of that concentration risk. And then it's also not that easy just to to fly over. It's a 5-6 hour difference. So I think there's a lot to be said in terms of our distance from the mainland. But I know that there was an attempt to acquire Hawaiian Electric at one point, sort of the parent company of ASB. So I know that those conversations are still happening out there. And as I said, great deals right now going on with our current market share. I'm sorry, current stock prices for the publicly traded companies here.
Actually, that's a really great lead into what I'm going to make this the last audience question that we take. But there is a question about why are Hawaii bank stock prices doing so badly? Like, why are they performing so poorly? And I know on a at a national basis, excuse me, regional banks in general, their stock prices have been hammered this year. So Hawaii is not alone. But what do you guys think? Especially if banks here are really safe, why are their share prices not reflecting that?
Yeah, I think I could take a stab at that. I think it's really driven by the headline risk, as we talked about, right? If you think about what happened with Silicon Valley, first of all, that triggered essentially a ton of bank analysts and investors looking at they kind of lined up all of the banks across the country, looked at all of the statistics around them, and really started printing articles about looking at specific indices or metrics, right? But the thing is about these metrics, they're not being put in context of the overall company and the overall market in which those banks operate in. So it's really myopic in nature, but that happens all the time. It happened in, again, 2008 global financial crisis. It happened again this year. So that's how things roll, right? You look at the bank indices, all of the stock prices, you've seen huge decreases overall, right, on a year-to-date basis. So that's definitely something that will permeate to Hawaii, regardless of how good we are, or how different we are, how separated we are from the rest of the country.
Yeah, that resonates with me, Phil. As we think, we're public, so we've kind of gone through the ups and downs. But what we tend to go back to is the core franchise in a lot of the Hawaii banks is deposits. And this was really a deposit crisis. So a lot of investors don't understand, or the public really doesn't know how that's going to play out. So deposit values were discounted. And as Phil mentioned, a lot of lists came out looking at just the asset side of the balance sheet. And because of our market being real estate heavy, we have a lot of real estate loans. The banks here also have a lot of securities, and those tend to be more fixed. And the valuations on those, haven't been as good. When you look at it on a standalone basis, a lot of the banks here don't shake out so well. But when you start to incorporate the deposits and the long-term value of deposits, it may look better. But if there's so much uncertainty around deposit behavior and the value of deposit bases, a lot of investors don't want to necessarily take that risk at this point. So it'll have to play out, and we'll see how the different banks fare. But my experience has been our deposit base is a lot more unique than some of these other banks that have had troubles.
Yeah, there's been not a lot of value placed on deposit franchise value, and I would argue the Hawaii market has some of the best deposit franchises in the country, right? For at least in my experience. So that's one thing that once you layer that into the equation, it definitely changes the outcome.
Okay, I've reserved the final question, again, moderator privilege. My last question to the panelists: for you guys, with our audience here, what are one or two things that you really wish that more people understood about banking, finance, this industry that you work in that, again, everybody uses, but very few people really, really understand? Yep, Rosetta, go ahead.
Sorry, I didn't hear the question again. Sorry.
Oh, I was just closing up, final question. What's one or two things that you really wish that more people understood about banking?
Uh, um, well, one of them is sort of the almost like it operates like banks operate like utility, and it takes a lot of volume to get at certain types of rates and certain types of pricing. It's highly regulated to the point where it chokes. It might choke innovation. Hence the rise of the fintechs. And really it's just that. So the supervisor, that level of supervision that occurs with banks is often not well understood by sort of the person on the street. So that kind of irresponsible behavior you might have seen from the past doesn't really occur, and particularly with regional banks, they're just as well scrutinized, not only by federal regulators, but also by state regulators.
Yeah, I would say that too, right? Don't paint all banks with the same brush, right? I think that's the key thing I wish people knew. It's to differentiate, especially, some of the things that you've heard from this panel, what we do locally, the time that our bankers spend in the community meeting with our customers, and taking board seats on community-based institutions. I think that, I would say that in my experience working in, this is my fourth banking market that I've worked in, and I would say it's the most community focused, right? So I think that's something that I wish folks understood about the complexion of the Hawaii banks relative to what you would see on the mainland.
Yeah, I would agree with those factors. I think, for us, it's like a delicate balancing act. We're trying to provide safety. We're trying to provide, services and value to customers. But ultimately, even though it's very numbers focused, it is a people business. We're out there trying to build relationships and make our customers comfortable while providing them a good value of whatever product or service that they're looking for. And it's a constant balancing act that we're trying to make, and the feedback is very helpful. So we do welcome that, but it's a people business where that connection with all of you folks is very important to us.
Great. And thank you again to our panelists for joining us and sharing your knowledge and experience. Thank you again for everybody attending. Let's see, I will turn it back to you.
Thank you very much, panelists. Appreciate that great discussion, especially those closing thoughts. That was really insightful, and appreciate you spending your time and talents coming to talk about these topics. I want to give a special thanks to our board directors, Laren and Rosetta, for coordinating today's event. And thank you, attendees, for joining us. Please complete the feedback form that will also be in the chat. Let me just drop that in there right now. All right, you should have that link there. Also, please mark your calendars. We do have our annual conference coming up in October, Friday, October 13th. Details will be announced soon. Please save the date. Thank you again to our sponsor, American Savings Bank. We appreciate your graciousness in hosting this event. And thank you to our returning attendees and those who are joining us for the first time. As you all know, we strive to make our events relevant and beneficial to Hawaii's diverse business community by tackling topics that are pertinent and breaking them down to make them accessible to a broad audience. I certainly hope that you found this to be the case today, and we look forward to your feedback. Please take a moment to respond with that feedback form. And thank you again for your time and attention. Aloha.
Thank you.
Thanks, everybody.